Good Monday. This is Jay Brew, chairman of Seafried and Brew. Continuing last week's discussion, the whole situation with debt. And we went back to 2007 and talked about the subprime and then the whole mortgage debacle as being really a debt-infused situation that caused us to have the financial crisis and then go into the Great Recession. Well, debt still has to be on our mind. But one of the things that we talked about last week was margin. And the margin accounts throughout the world, and especially in China, where 99 million are estimated to have margin accounts. Now, this has started to decline as the Chinese stock market has dropped close to 50% from its high. So what are we looking at in terms of debt globally? $29 trillion worth of global corporate debt. And think about that amount, especially from the standpoint that debt to earnings ratio are now at a 12-year high. Bloomberg estimated that 1/3 of that debt is not being able to be covered from earnings. So what kind of impact is this going to have? But let's come back to margin and look at the U.S. And since 2010, margin in the U.S. has been up close to 67%. And it's basically just flattened out in here. We haven't seen it decline since we've had the stock market and the Dow being down 10% from its high. So what is going to happen here in the U.S. in terms of those margin accounts? Will they start to decline as these stock markets continue their chaos? And that's why I put it that it's an overall level of chaos that is causing us to have the 10-year Treasury in here move down to 1.88%. So when we think about that, will rates continue to remain low? Yes, in my estimation, based upon this global chaos, the amount of debt that's piled up, and the amount of margin that is out there. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.